Hi, this is Anthony. Welcome back to my show. You know, the hardest part of investing in the stock market is also the easiest, and that's just opening up the account. The hard part is actually deciding to do it, picking up the phone or going online and actually creating the account. But it's pretty easy. Years ago, when I set up my Roth IRA, I went into a local office of a stockbroker that was a no commission or a low commission company at the time. They were about the lowest commission. They were bought by another company that eventually was bought by Schwab. They no longer charged commissions. That's something that most stockbrokers don't charge anymore. It used to be that you paid between $14 and $40 per trade. So if you bought something, it costs you 14 up to $40 to buy, and then when you went to sell. So the stock had to go up quite a bit just for you to break even. These days, generally, there's no commission. Find your own. I'm not going to recommend to you. I mean, you could use Robinhood or Schwab, Fidelity, Vanguard. Just make sure that it's a no commission broker. Okay, so once you set that up, and it should be pretty easy to set up, sometimes you might have to provide some identification to them. They have a know your customer regulation that the federal government imposes on them. Anyway, once you've created that, then what type of accounts do you have? Generally, you'll have a regular account, and that's just a taxable account where if you bought something and you made a profit on it, and when you sold it, you'd have to pay capital gains tax on the profit, not the total, but the profit. If you lose money, then you can deduct that from your profits. If you don't have any profits in the stock market, then you can deduct up to $3,000 of losses against income if you're employed. This is not tax advice. Check with your tax advisor, but it's pretty accurate. Anyway, that's a regular account. Then what I would recommend for people that want to save for retirement is open up a Roth account. So that's just a separate account with a different number at whatever place you decided to go. So at Schwab, I have two accounts, a regular account and a Roth account. And I've been trying to fully fund my Roth account for about 10 or more years. Now, how much can you put in? It used to be that you could only put in $2,000 a year. That isn't very much, and things have changed since then. So in 2025, the maximum Roth IRA contribution limit is $7,000 for individuals under 50. If you're over 50, then that's $8,000. So I'm over 50, I can put $8,000 into it. If you're under 50, you can only put $7,000 into it at this point. What do you put it in? Well, you could buy individual stocks, but most people don't want to take time to do the research. So something that a lot of investment advisors, legitimate ones, are going to recommend, and I'm not an investment advisor, so take this with a grain of salt. I'm just entertaining you with some knowledge, is the S&P 500. So Standard & Poor's. It's just a company that came up with a list of 500. Basically, it's the top 500 stocks in the United States stock market. Okay. So let's see how they've done the last month. It's up 3.45%. Year to date, up 3.15%. Over the past year, it's up 12% or more. Almost 100%. So in the past 5 years, you would have about doubled your money. Now, this is the stock price. They do pay dividends, very small dividends. So you could add that to this. So it is more than 100% if you add in those dividends. They say that the average stock market, the stock market goes up on average about 10% per year. Now, some years it may go up 50% or 20%, and some years it might be down 40% or 30%. So you need to understand that it's not a guaranteed 10% every year. But over the long term, the average is about 10%. Let's take a look at this again. Here's the max. It only goes back to 1993, March 5th, 1993. If you would have bought one share at $44.75, be worth $603.08 now, or over 1,200%. So pretty good rate of return over the long term, but be aware that there's times like this is the top of the dot-com bubble, and then it went down, and then it went up slightly, down again. It took a number of years, and people call this the lost decade, where they argue that the S&P 500 basically returned zero. Now, that's probably not quite true, because you are getting dividends, and also people rarely just buy at the top and then never invest again. Most people don't have enough money if you're going to put your $8,000 in or $7,000 in to your Roth IRA. Most people don't have it to put in at the beginning of January. So you might dollar cost average each month. For instance, you could put, I think it's $583.33 per month over the course of a year to fund your $7,000 if you're under age 50. It's $291 bi-weekly. If you put $134.61 each week, that would get you up to $7,000, or it's slightly under $20 a day. And you can set it up so that it takes it out of your paycheck or your bank account. Anyway, it's probably best that you periodically buy stocks or mutual funds, for instance, this one, if you decide to do that. Now, you could obviously put some money in other things like Microsoft or Nvidia or Tesla, but the risk with those is that they might stumble, they might have a change in leadership. If you have an oil company, you would think that oil companies, since we all use oil and gasoline for all kinds of things, would be a pretty good investment. But what happens when one of their ships runs aground and leaks oil all over, and they have a charge of billions of dollars for cleanup? That could really impact a particular oil company's bottom line for a long time sometimes. So a lot of people put their money into this, and the symbol is called SPY, SPY. So that's what you would type in to buy. Now, there's another one that is very similar, but it's a growth index, so it slightly tweaks it, and VOOG is the symbol for that one, and that's the one I have. I have a few shares in this. Again, I like to do research and invest in individual stocks, but I do have a little money in the S&P 500 and also the NASDAQ 100. So the S&P 500 Growth Fund and the NASDAQ 100. Let's do a little comparison between this one and the other one. Okay, so the Growth Fund over the past year, past 52 weeks, is up 17.72%. And if we go to this one, it's 12.32%. So the difference is 12 and 17. See that? Okay. Let's look at the 5-year. 5 years, this one's up 111%. And again, just under 100%. And again, if you do some research, there are quarterly dividends that are paid. This is the VOOG. And it can change. It can go from 91 cents one quarter down to 30 cents, up to 43, 52, 53, 54. So that just happens to be based on what dividends are being paid by some of the components of that index. And then let's look at the max here. This one only goes back to 2010, so it's not a great comparison. So, but obviously it would have outperformed the SPY. Okay, so I think I'm going to stop here, but this is the type of thing that if you're going to put money into a retirement fund, hold it for the long term. This would be something that you could buy and just forget about. If there's a stock, a company in this fund that goes bankrupt or is stumbling, is doing poorly, then it'll be taken out and replaced with a stock that's doing better. So you're not going to have all 500 of these go bankrupt in 1 year and lose all of your money. That's not how it works. So there is a lot of safety in this type of thing. But again, it could go sideways if the economy goes sideways, as we saw for the so-called lost decade of the early 2000s. So I'd love to hear from you. What are your thoughts? Do you own any of these? Have I prompted you to investigate more, perhaps open up a Roth IRA and do some of your own investing? Love to hear from you. Be sure to subscribe if you haven't already, and hit like, and check out my other videos. I cover a wide range of topics, but I'm trying to do a lot of finance related ones. Thank you so much.